Right now, the middle class is entirely distracted by the AI hype. But while everyone is looking at tech, billionaires like Bill Gates and massive institutional funds are quietly hoarding a completely different class of tangible assets. Private equity is going to war over a very specific mathematical arbitrage. They are aggressively acquiring businesses generating $200,000 a year in cash flow for a flat purchase price of just $600,000. The broader markets are masking this entirely. The S&P 500 is being propped up almost exclusively by just 7 tech giants, blinding retail investors to the massive wealth transfer happening right underneath them. To build actual multi-generational wealth, you have to ignore the loudest markets and step into the shadows to find assets that are criminally underpriced. Here are 15 of them right now. Number 15 is legacy media. Think local newspapers and 20-year-old hobby magazines. These are currently priced like melting ice cubes, but they retain highly loyal older demographics with massive buying power. Local TV ad revenue is projected to jump by over 25% by 2026, largely driven by political spending. In a digital world where AI makes all content look exactly the same, authentic legacy intellectual property is incredibly valuable. Number 14 is commercial office space. National prices are still down over 30% from their pre-pandemic peak, and the construction pipeline for new space has completely stalled out to a 3-decade low. Smart money started aggressively buying this up 18 months ago. The play here is adaptive reuse, acquiring deeply discounted high-rises and converting them into apartments, medical centers, or life science hubs. Number 13 is international real estate. You can barely buy a decent home for $100,000 in the US anymore, but overseas, the dollar is incredibly strong. Premium real estate in places like Portugal, Italy, or Thailand is trading 30 to 50% below 2019 levels in dollar terms, offering massive rental yields and an inflation hedge. Number 12 is farmland. Corn prices are down, fertilizer is expensive, and farm income has temporarily dipped. This exact scenario is why the ultra-rich are swooping in. It is bulletproof collateral that can be leased for solar energy or held as a multi-generational hedge. Number 11, physical commodities. Everyone is buying AI software stocks, but they're ignoring the infrastructure required to run them. Every data center and grid upgrade requires massive amounts of copper, and tech giants are buying nuclear power plants just to keep the servers on. The limitless digital future is entirely dependent on and bottlenecked by whoever owns the finite physical infrastructure of the past. Number 10 is non-office REITs. Real estate investment trusts are legally required to pay out 90% of their taxable income as dividends. You can buy shares in the trusts that own the Las Vegas Strip, massive server farms, or cell towers, often at a 30% discount to private market valuations. Number 9. This chart shows bond yields over the last decade. For 10 years, bonds were a flat line, paying almost nothing. Now, look at this sudden, sharp spike. The 10-year Treasury and investment-grade corporate bonds are paying massive yields, and municipal bonds can offer an equivalent of 6% completely tax-free. Number 8 is energy stocks. The cultural focus on green energy has artificially deflated the price of massive cash-printing fossil fuel companies. U.S. data centers will soon consume 17% of all domestic electricity, and the grid simply cannot survive on wind and solar alone. Number 7 is healthcare stocks. Temporary panics over cyber attacks and post-pandemic hangovers created huge entry points. Giants like United Health lost 54% from their peak, creating a deep discount that smart money, including Warren Buffett's Berkshire Hathaway, aggressively capitalized on. Number 6 is cybersecurity. When AI agents started writing network exploits autonomously, retail investors panicked and sold off their cyber stocks. In reality, major infrastructure projects are licensing massive defense contracts to plug these exact holes, and digital defense budgets are about to explode. Institutional wealth expands its footprint in these sectors exactly when retail investors retreat. They use cultural shifts or temporary public panic as a mechanism to secure cash-printing assets at a significant discount. Coming in at number 5, international stocks. For the first time in over a decade, markets in Europe and Japan are outperforming the US. The exact same company fundamentals that cost you $23 in the US cost just $15 overseas. At number 3, we have emerging market stocks. Mexico is currently experiencing a massive industrial boom driven by nearshoring.
Genuine, measurable infrastructure growth is happening right now in emerging markets, trading at roughly half the valuation of U.S. companies. Number 4 is next-generation peptides. Alpha in the pharmaceutical space is shifting towards cellular regeneration and cognitive repair. Compounds like retatrutide and GHKCU for tissue repair are moving through development pipelines to transition from injectables into daily pills. Because this shift is expected to increase consumer volume 30 times over, major pharmaceutical firms are aggressively positioning themselves in this space through targeted biotech acquisitions. Number 2 is Bitcoin. This chart maps historical crypto cycles, showing a brutal 40% mid-cycle drop before the massive second leg up. Now observe exchange reserves. The supply line drops to record lows, proving institutions quietly accumulate during panic while retail sells. Exponential value isn't found in overvalued domestic stock indices. It is captured by following global demographic growth and decentralized accumulation. Number 1 is cash-flowing boomer businesses. Over the next 5 years, roughly 600,000 businesses owned by baby boomers will be sold or shut down, simply because the owners want to retire and have no succession plan. You can acquire highly profitable, essential services like HVAC companies or commercial roofing operations for a mere 2 to 4 times their annual cash flow. In many cases, the retiring owners will even finance the deal for you. Finally, a bonus asset class, distressed sellers. In every single market, there are owners facing sudden personal or financial crises, like divorce, tax liens, or liquidations. If you show up with proof of funds, empathy, and a 14-day closing window, you solve their most painful problem quickly. You can secure real estate and business assets for pennies on the dollar. This is the ultimate rule of acquisition. When a seller's priority is speed rather than price, the buyer dictates terms and captures the wealth. True wealth is rarely built when the markets are screaming. It is built in the quiet, calculated moments when unglamorous assets are heavily discounted. If you made it to the end of this video, drop the word quiet in the comments below so we know who the real action takers are in this community. To stay ahead of the curve and learn exactly how to build and preserve generational wealth, make sure to hit that subscribe button. You've been watching The Money Formula. We'll see you back here next time.